In Signal episode 20, we explored energy, power and renewable sector, a space that's shaping India's transition to cleaner and resilient future. In Signal episode 21, let's turn our attention to a sector that quietly sits beneath almost every growth story in India, yet tests investors' patience more than the most. Metals and materials. We're talking about aluminium, steel, copper, cement and industrial inputs, the materials that form the physical backbone of infrastructure, manufacturing, housing, mobility and even the energy transition. This is a sector that does not always move in a straight line, but plays critical role when an economy steps into capital expenditure or capex cycle, when nations build capacity, expand infrastructure, and invest for long-term growth. So let's begin with strategy of the week, move to story of the week, share a fun fact, review market highlights and conclude with a powerful reflective quote of the week. Welcome back to Signal, where noisy markets meet simple, sharp and sound insights for long-term investors. Metals and materials is one of the most misunderstood sectors in investing. It is foundational to economic activity, yet highly cyclical in nature. Every bridge, road, power plant, factory, railway line and housing project begins with materials, yet earnings in this sector fluctuates sharply, driven by commodity prices, demand cycles, currency movements and capacity additions. This is precisely why metals and materials tend to reward investors in distinct phases as cycles unfold, rather than a steady, linear journey. So let's look at how should long-term investors approach this sector. Firstly, let's understand the role it plays. Metals and materials do not drive consumption. They support growth, particularly during capex-led phases of an economy. Secondly, most mistakes happen when investors invest in popularity instead of profitability and fundamentals. Exposure often increases when optimism is at its highest and valuations reflect peak earnings. Thirdly, choosing the right investment vehicle is critical. Diversified equity funds remain the preferred core approach as professional fund managers dynamically adjust exposure based on earnings visibility, valuations, and cycle maturity, reducing the need for investors to time the cycle themselves. Sectoral funds can offer tactical participation during phases of improving demand visibility, rising capacity utilization, and strengthening balance sheets. Allocations must remain mindfully measured, preferably under expert guidance due to underlying volatility. In some cases, a fund of funds structure can provide moderated participation without taking direct concentration risk. Direct stock investing demands highest level of research, conviction, and expertise. Investors should focus on low-cost producers, strong balance sheets, pricing power, and management teams that allocate capital conservatively across all cycles. A question worth asking before increasing the exposure is, am I investing because cycle is improving right now or because the sector is popular right now? The golden rule is that metals and materials should be a supporting beam, not the foundation of a long-term portfolio. And here is where a SEBI-Registered Investment Adviser adds real value by selecting the right investment vehicle, by sizing the right exposure, avoiding cycle chasing, and rebalancing as conditions evolve. For story of the week, let's meet Arjun, a 41-year-old infrastructure consultant. In 2021, global commodity prices surged, metal stocks delivered strong double-digit returns. Headlines were dominated by steel and mining stocks. Like many investors, Arjun asked the obvious question: which metal stock will benefit me the most? With this question in mind, he decided to review his portfolio with his SEBI-Registered Investment Adviser. But instead of discussing stock names, the advisor reframed the conversation with two clarifying questions. Are you seeking participation or precision? And more importantly, are you responding to fundamentals or to recent performance? That shift in perspective changed everything. Arjun realized that metals and materials were never meant to drive returns every year. They were meant to support India's infrastructure and capex cycles. Instead of chasing individual stocks, Arjun kept a small, deliberate exposure through diversified equity funds, treating metals and materials as enablers, not a shortcut. As the cycle cooled, Arjun's portfolio remained steady. As demand normalized, metals and materials played their role. The lesson is simple. Better investing rarely begins with answers. It begins with asking right questions and resisting the urge to chase noise, hype, and trends. And on a lighter note, here is a quick fun fact. Did you know that steel can be recycled again and again without losing its strength? In fact, a significant share of global steel production today comes from recycled material, making steel one of the most circular and sustainable materials in the world. Now let's look at the market highlights of the week ending 26 December 2025. The Sensex closed at about 85,041 points, up by about 112 points from last week's close. The Nifty ended near 26,042 points, up by about 76 points from last week's close. Markets were shaped by mixed global cues and year-end positioning. Cyclicals including metals softened while defensives held up. Foreign institutional investors remained cautious while domestic institutional investors provided steady support. The rupee ended near 89.9 per US dollar. Overall, a week that began with mild optimism but ended with caution as markets consolidated, volumes thinned, and investors positioned thoughtfully for the new calendar year 2026. As we consolidate 2025 and step into 2026, it's worth pausing and reflecting on this powerful reminder from Howard Marks. The most dangerous thing you can do is buy something because it has gone up. This is especially true for metals and materials as they are not momentum sectors. They are specialized, sensitive, and cyclical to global factors, which means the exposure must be selective, not sensational, sized, not stretched, strategic, not sentimental, and structured, not speculative. Investing success in sectors like metals and materials is rarely about speed. It's about structure, self-control, and staying balanced through the cycle. And this is precisely the reason why a SEBI-registered investment advisor matters, to bring skills, scale awareness, and sound sizing, because these matter more than speed. In our next episode, let's explore the movers and shakers of 2025 and why market behaviors matter more than market predictions. We can't wait to unfold all this together, so catch you back next week. We are building a strong community of methodical, mindful, and meticulous long-term investors. If you're one of them, why not like and subscribe us and tell us in comments, what did you learn from markets in 2025? Patience, discipline, or adaptability?